Hi, my name is Chris, and I'm here today to talk to you about taking credit card payments. Now, for most consumers, this is a very easily overlooked convenience, but for businesses, it's a big deal. The reason why is for most companies, credit cards is the entry point for commerce. And on a grander scale, credit card processing is part of a payment ecosystem that impacts cash flow and the way that money moves at a local, national, and global level. It impacts economies at all levels. So it's an important topic to understand. And I've actually written on the board bank card here in substitution of credit card, even though credit card is the commonly used term, because we're going to talk about both credit and debit cards in general, bank cards, bank issued cards. But it's important to note, we're going to talk about those together, but you should know that debit and credit cards are actually treated differently on the back end. There's a lot of things that happen differently behind the scenes. With that being said, though, looking at taking credit card payments in general, it's a huge topic. There's lots of things we could cover and discuss. But what we're going to do is we're going to focus on the three important areas you need to understand. And you're going to want to stay tuned and watch this whole video because I'm going to cover some industry secrets that is going to help you understand the topic better than you've ever had before. So rather you're a brand new merchant or you've been doing this for a long time, taking credit cards for a long time, you're going to want to watch this video and understand all the things I'm going to tell you. So we look at understanding taking credit card payments. We want to understand the three important money F's. And what I call these the three F's of taking credit card payments. And what those three F's are is the first one is funds. And I'll explain that in a second. The second one is fees, which everyone's kind of aware of this. And the last one is safety. And just a quick explanation on these three issues. We're talking about funds. We're talking about how funding happens. Not only how quickly it happens, but the frequency of when funding is going to be is important to understand. We're looking at fees. We're talking about all the fees associated with taking credit and debit cards. So understand the fee structure is important. And then last thing is safety. And this is safety not only of your business information, but also safety of your consumers and your customers that are out there of their credit card information. So we're going to cover all three topics. Now, the more important, I guess, specifics of that is really how fast you get your money, how much you pay in fees, and how safe is my information. That's kind of the easy way to think of it. So the three areas we need to understand is the merchant type. So when I say merchant type, what I'm really saying here is how you take payments. Now, how you take payments impacts all three of these issues. It's going to impact how quickly funds come through. It's definitely going to impact the fees. And then, of course, the safety and the security involved in it as well is going to matter. So how you take payments, there's actually three categories here as well. You're going to see there's a lot of threes this is grouped into. We talk about how we take payments. We're looking first what we call a retail merchant. This is kind of the general category, but what we actually refer to this as in the industry is we call it a card present type of merchant, or what we call a face-to-face, meaning that the card is presented face-to-face. The consumer's handing the business owner a credit card or the clerk a credit card. This could be at a restaurant. This could be at a retail location. It's the most common places you're going to see that. We also have what's called in the industry MOTO, which stands for MO as mail order and TO as telephone order. But mail order is a little outdated for today's internet age. I think a better way to understand it is anybody who's not card present. But obviously, we still have a lot of telephone order, so that falls in here as well. A good way to think about it would be mobile merchants, where the card's not going to be present, handed over. They're either giving it to you right now, the credit card information, or there's going to be over the phone, the information's given. And the last is going to be the online, internet, e-commerce type business. And so when we look at this list, we're getting three basic categories of merchant types for how to take payments, but really these two here kind of get grouped together from a risk, a safety, and a fee standpoint. When we look at retail merchants, the card present merchants, that's where we're going to get the lowest fees, and it has to do with the risk involved with the credit card processing. It's a lot harder to commit fraud when you have to give someone your credit card, especially if you have to produce an ID, match the signature, and checking all the information. It's a lot easier to go online to a website and put some stolen credit card numbers in and pay for an item that way. So it kind of gets riskier as you go. But what you'll find is most merchants are actually a combination, and some merchants are all three. And with new technology today, especially with smartphones, with mobile app processing, you're finding some traditionally mobile merchants that are becoming retail. Good example is my uncle. He owns a mobile remodel business. He takes all his credit cards on site. So for years, he was writing the information down, going home to his home office, and typing in the credit card information. Now, he has an iPad. He has a swiper that plugs into the side of the iPad. He's able to process the card there with the customer. They feel safer about it. He gets a lower rate. It's lower rates. It's safer, and then actually the funds come through sooner because he's getting the transaction done earlier in the business day. So that's just an example of what I'm talking about. So how do you take payments, or the merchant type is an important area you need to understand. Now, if you're a restaurant, you go, well, I'm obviously face-to-face. Well, do you take any phone orders? Well, you're going to fall into a Moto category there. If you're a takeout type place or take credit cards over the phone, those are going to be Moto transactions. So you're going to have a balance. I would say virtually all businesses have some combination of these three things. Very few have just one, unless they're maybe just an online business only, or just only retail, only on location. So understanding this is important. So you need to understand the way that the credit card processing companies do this. They put them in buckets, and they'll say, well, I'm going to do 80% retail, I'm going to do 10% Moto, and 10% online. And what that does is it gives the credit card processing company an idea of where these transactions are going to fall, and I guess an idea of what the risk is associated with the processing. For you as a merchant who I'm speaking to in this video, you're going to want to try to get all your transactions to a face-to-face card present type of environment, which means you're actually going to physically want to swipe the card. This is going to guarantee the lowest rate, the most secure, safe transaction, and the fastest funding. So this is going to be your best option. Whenever you can, take a card present. Obviously, it's not always possible, but when you can, that's what you want to do. Okay, so how to take payments is the first one. Now, I'm going to erase this and give us some room. The next thing that we want to understand is what's probably the most focused on part of how to take credit cards, or when you're first getting set up, is the merchant agreement. Now, I call a merchant agreement because this is the most kind of a common term, but in reality, it's called an application. It's called basically it's a contract. It's a contract between the merchant and the credit card processing company or the sales organization that's facilitating it to accept credit cards. And it's definitely a full contract. The thing to be kind of cognizant of is that in the field, the application, the agreement, and the contract, the terms are all bundled together. So you have your personal information on there, your business information, you have the Schedule A, the fees, you also have the terms like what's the cancellation policy, the rules and regulations. It's all one bundle. And the reality is 95%, maybe probably closer to 100% of the merchants out there don't read it. In fact, I have my own merchant account and I didn't read it. Not because I don't care, but because it's 40 pages of terms and conditions, and frankly, most people don't read it. So you need to know what to look for, the critical items, to make sure you're covered. And here's what those critical items are. You want to understand the fee schedule. It's typically on the second page of an agreement, and this is also called the Schedule A. You want to take a close look at that. We're going to dig into that in a second. But you also want to look at the contract term, and you want to look at the cancellation policy. You need to understand those three elements. They're very critical. They can impact your business later on. So we look at the fee schedule. What are we talking about here? Well, there's three elements to this as well. We're talking about your interchange rates. You're talking about your discount rate and transaction fees. And we're going to talk about the monthly standard rates and the service fees. I'm not going to go into them in great detail because it takes a long time to explain this, but just let me kind of go through it very quickly. So we talk about interchange. We talk about that's the cost to process. Everybody in the world pays this. Even the biggest credit card processing businesses in the world, the Walmarts and the Starbucks, they pay the interchange rates. They pay this cost. That's how it's referred to a lot of times. You're going to pay that no matter what. It's 70 to 90% of what the processing cost is. So that's something you need to understand. A lot of times it can be hidden in the agreements, and it won't be completely visible in the merchant statements. But that's part of it. The other part of it, this is kind of one. The other part of it is the discount rate or the transaction fees. And this is where the processing company has profitability. Now, it's not, let's say they're charging a discount rate or an interchange rate of 1% over interchange. That's 1% of your processing volume they take as revenue on top. So that's your gross revenue. It's not 100% profit because most companies have what's called a buy rate or a price floor they have to deal with. And all companies, even guys that don't have buy rates, have to deal with acquiring costs and merchant service costs. So it's not a true profit. It's more of a revenue number. But regardless, it's where you have negotiation room and lowering your fees. So the discount rate and the transaction fees you have associated, this is not just your authorization fee. This is also batches and ADSs and stuff like that. And then, of course, the monthly and service fees are the important ones. Things like PCI and things like monthly minimums and statement fees, we're going to cover in some other videos. Those are important to understand. This is where you have room to negotiate and get your fees lower. But the other thing that in this fee schedule that's going to be important to understand is a lot of times it'll be in here or it'll be later in the T's and C's is your funding time frame. And you're going to want to make sure that you have the most optimal funding time frame. I've seen anywhere from 72 hours to 24 hours. And obviously, quicker is better. And so make sure you understand what that is because a lot of people miss that. Last thing is the contract term. This is a pretty hard, fast term in the contract. Now, a lot of times people say, hey, I can get you out of it. It's a 3-year term. Just sign it. Really, you're obligated to be in that term. So understand that when you're signing that, that's a real thing. But here's the deal. Here's why they do contract terms. In this industry, all the salespeople are either paid straight commission or they're paid. They have a quota they have to meet, and so these guys only get paid when the merchant processes. So if they spend 10 hours signing up a merchant and that merchant cancels the next day, then now they just spent a bunch of time, money, gas on that merchant, and now they're canceling. And if it's for just the reason they feel like canceling, that's a big loss. That's why there's contracts set up to help protect those salespeople. And there's some shady stuff there. We won't get into great detail today, but it's important to understand what the contract term is. And of course, the cancellation policy. A lot of times it's going to be a flat fee. A lot of times it'll be the monthly minimum or the account minimum fees multiplied out by the rest of the term. Understand what that is. These are all going to impact fees. Obviously, is a big part of this, but it's also going to be an important part of your funding as well when you check the actual merchant agreement. So that's enough there. Let's cover the last critical area to go through, and that's the one that it's really, people get really focused on it, and it's important, but it's not the biggest deal when it comes to this. It's more of a convenience in your business and making your business run more efficiently and effectively. And that is the technology, the device that you use to actually take credit and debit cards. And with this one, we have the old school terminal, the standalone credit card processing terminal. That's a very common setup for most merchants today. Actually, this works very well. The good part about it is they're durable and they don't break. They're pretty reliable. The downside to it is it's just for credit card processing. It doesn't store any extra data like customer information. It doesn't store your inventory for you. So you have this one piece of hardware dedicated to taking credit cards, and it also, problem with hardware is it becomes obsolete every couple of years, so you have to replace it every so often. But pretty cheap too, so it's a decent solution for a lot of merchants. The other one that's becoming more popular is the gateway, and this is the gateway, the virtual terminal. I love this solution because what it does is it gives the merchant a lot of flexibility. With the gateway or virtual terminal, you can use it on a PC. You can plug in a USB mag swiper, and you can make it like a regular credit card terminal. You can hook up a printer to it, do the receipt thing. With an iPhone or an Android or an iPad, any kind of tablet, you can do a gateway with an application, and you can have mobile credit card processing. Plug in a swiper that's compatible with your device, and now you have card present. Even if you're going to do a terminal or have another solution, having a gateway as a backup is a great idea in case you lose, your hardware breaks or fails. Problem with gateways, of course, require internet access. So if your internet goes down, you can't dial up to use it, like you can have the terminal in some cases. The last one has been around just as long as the terminal, and this is, I'm just going to put point of sale, but what I'm talking about here is I'm talking about integrated software and hardware solutions. And with technology the way it's growing today, you're seeing everything become more integrated. In the old days, you had just the big box places like the Targets and the Best Buys. They had to have point of sale because they needed to be able to track inventory. They needed to be able to understand, get more detailed analysis and reporting. So they had point of sales. And then, of course, restaurants needed the touchscreen capability of a point of sale for the quickness of service, and they needed the ability to be able to see in nightclubs and bars with the light up screen. So a point of sale has been a must for those guys for years. But for all businesses, it's really important because you can track extra data in it. And typically, the point of sale systems are really durable and are powerful enough to be able to handle a lot of abuse and do a lot of computing for you. So integrated solutions, there's really a lot of good ones out there. A really good example that people are really familiar with, not necessarily the best solution for you based on cost, but the integrated solution would be like an Intuit. Intuit has QuickBooks where you can take payments in QuickBooks. They have a mobile app that integrates. They have the online store that plugs in, and then of course it's an accounting software. So you have this full integration, which is great for like a T-shirt maker who doesn't have to process very quickly. He can do invoices and stuff like that. That's a great solution for someone like him, or maybe a PC repair shop. So point of sale is the last technology. Now, why these are important for the 3Fs is how these are set up is going to determine how quickly you get your funds, because you're going to want to make sure these are batching correctly, and what batching is sending your information to the processor so they can move the funds for you. So how these work is going to impact your funding. Of course, it can impact your fees because if they're not processing correctly, you're not going to get card present rates. So you're not going to have the lowest fees possible. And then, of course, from a safety standpoint, you have to have the most up-to-date, what's called PCI compliant hardware and software, which will keep you secure from people hacking in and stealing your information. So understanding the technology is very, very important. So just to summarize, let's go back through. So if you're just getting ready and getting started on taking credit card payments, the things you're really going to want to take a hard look at is what type of merchant are you? Understand what type of merchant you are, what the mix is you're going to have. Next thing we're going to want to look at is we're going to want to look at the merchant agreement. Spend some time. Even if you trust the person that's doing your account. Like I said, my uncle earlier, I did a merchant account for him. But at the end of the day, the processing company has the final agreement with my uncle, and he trusts me, and I told him it was great, but he still went through and read it because he's a smart business owner, and he wanted to know what he was signing. So understanding the agreement is very, very important. The last one you're going to want to understand is the device or the technology that's used to take payments. So if you're brand new or you're seasoned, take a look at this and make sure it's in line with your current business strategy. And if you have any more questions, feel free to leave them in the comment section below.